So, you're looking to buy a stock. How do you actually know if the price is fair? Are you getting a good deal or are you maybe overpaying? It's a fundamental question that every single investor has to face. Today, we're going to dive into one of the classic tools designed to help you answer exactly that.
All right, to get us started, let's try a simple story. I want you to just forget about stocks for a second. Instead, imagine we're down at a harbor and we're looking at two different ships that are for sale.
So, over here, you've got Ship A. It's brand new, it's fully stocked with all the latest gear, and it's sailing perfectly. And then you've got Ship B. It's old, it looks like it's barely staying afloat, and a ton of essential equipment is missing. But here's the real kicker, they're both being sold for the exact same price. I mean, the choice seems pretty obvious, right? Of course you'd buy the new, fully equipped ship. But what's wild is that in the stock market, investors sometimes accidentally choose the old, rickety ship without even realizing it. Making that right choice means you have to look beyond just the price tag. And that's exactly where a tool like the price-to-book ratio comes in. It helps us kind of peek under the hood and see what a company is fundamentally worth based on the stuff it actually owns. At the heart of this whole thing is something called book value. And honestly, it's a really straightforward idea. All you do is take everything a company owns, that's its assets, and you subtract everything it owes, those are its liabilities. Whatever's left over, that's the company's net worth, that's its book value. So, what do we do with this book value? Well, we pop it into a super simple formula. The price to book ratio, or P/B for short. You just take the stock's current market price and divide it by the book value per share. It's a really direct way to compare what the market thinks a company is worth versus what its own books say it's worth. Let's just walk through a quick example so you can see how this works. Imagine company A has 100 million in assets and owes 40 million in debt. So, its book value is 60 million bucks. Simple enough. Now, if it has 10 million shares out there, the book value per share is just $6. Okay, so if the stock is currently trading at $12 a share, we just divide that 12 by our 6 and we get a PB ratio of 2. Okay, so we've got our number, it's 2. But what does that number actually tell us about the stock? How are we supposed to read that? Well, here's the general idea. If the ratio is below 1, you might have found a bargain. The stock is literally trading for less than its net worth. But, and this is a big but, it could also be a major red flag. A ratio of exactly 1 suggests things are pretty much fairly valued. And anything above 1, like our example of 2, means investors are paying a premium, usually because they're betting on some serious future growth. But this is where context is absolutely everything. A huge tech company might have a P to B of 10.5 because its real value isn't in buildings, but in its code and its brand. Meanwhile, a furniture company with a ratio of 0.7, well, investors might think its inventory is just plain outdated. And then you have a bank whose assets are actual tangible things, like cash and loans, so its P to B ratio is going to hover much, much closer to 1. And that brings us to a really crucial point. This tool works best for those asset-heavy industries. Businesses where the value is tied directly to physical stuff you can actually count and touch. Think banks, real estate, and manufacturing. But, and you knew this was coming, relying on this one number can be so dangerous. The PB ratio is not foolproof, and the most powerful warning for that comes from the 2008 financial crisis. So during the crisis, bank stocks just got hammered and their PB ratios fell way below 1. On paper, they looked like the deal of a lifetime. So investors rushed in thinking they were buying a dollar's worth of assets for maybe 50 cents. The problem? That book value was basically a lie. So many of these banks had hidden these incredibly risky investments that were actually worthless, which meant their true net worth was way lower than what they were reporting. And this really hammers home the biggest lesson from that whole mess. A low PB ratio is not an automatic buy signal. It can just as easily be a huge warning sign that something is seriously, fundamentally wrong with a company. So with that pretty scary cautionary tale in mind, how can we use the price-to-book ratio like a smart, informed investor? Let's try to bring it all together. A good way to think about it is this. The PB ratio is like checking the price of a house against what the bricks and lumber cost. It's useful information for sure, but it is not the whole story. It doesn't tell you a thing about the neighborhood or the future potential of the area or the quality of the design. I mean, a perfect example is a company like Coca-Cola. It has a PB ratio way above 10. Now, why on earth would anyone pay 10 times its net worth?
Well, it's because you're not just buying its bottling plants and trucks, you're buying one of the most powerful, most recognized brands in the history of the world. And that kind of value just doesn't show up properly on a balance sheet.
Okay, so let's wrap this up with the most important things to remember. The PB ratio, it's a simple comparison of a stock's price to its net worth. It works best for companies with a lot of physical stuff. And most importantly, a low PB ratio shouldn't make you act. It should make you ask a question. Why is it low? Are you looking at a hidden gem? Or are you looking at a sinking ship?
At the end of the day, the price-to-book ratio is just one tool in your toolbox. It's a great one for helping you understand what you're paying for, but it's always up to you to figure out if what you're paying for is truly what you're